Hi, I'm Candis Fitch, Portfolio Manager at IAIC, and welcome to another episode of In Focus. Today, it's a Portfolio Manager takeover on the podcast as I fill in for Mike Gasowitz as host. And today I'm joined by fellow Portfolio Manager Steve Cornell, who is responsible for our financial sector. Welcome back to the podcast, Steve.
Thanks, Candis.
So let's get into some hard questions here. On a previous episode of In Focus, Joel Baker discussed the Silicon Valley bank failure. But unfortunately, that hasn't been the only bank failure that's made the news. Can you recap for us what has happened in the finance sector since SVB's failure?
Yeah, sure, Candice. There's been a lot of action there. So I'll just start out by pointing out, and this is obvious, there was a significant amount of volatility in the finance sector during the month of March, and that all started with the collapse of the U.S. regional bank, Silicon Valley. And I'm going to refer to that as SVB throughout the conversation here, and that occurred early in March. And so the fear of contagion because of this SVB deposit run and failure led the Federal Deposit Insurance Corp, the FDIC, to shutter another regional bank, New York's Signature Bank, just days after SVB was closed by the Federal Deposit Insurance Corp. And what the FDIC did is transferred all deposits to a new entity created and controlled by the FDIC called Signature Bridge Bank. So that was the second regional to fall in a couple days. And both SVB and Signature collapsed under the weight of really heavy losses on their bond portfolios because of this massive deposit run that they were experiencing. And a high proportion of those deposits were uninsured and invested in hold to maturity bonds. And that really was the devastating blow, was just all these deposits being pulled out, having to sell bonds at losses, and just it became too much for the regional. And this was the case for both of these regionals. And then under a similar pressures, a third regional, Silvergate Bank, announced they were winding down operations and selling their bank assets about the same time. So they sort of solved their own problem privately.
Right.
Shortly after that, and now we're into mid-March, a $300 billion rescue was arranged by the largest U.S. banks to backstop deposit withdrawals at another regional bank, First Republic. And since SVB's failure, First Republic's share price is down around 95%. Wow. And it has suspended its common and preferred dividends and continues to lose deposits. And First Republic is currently looking for additional assistance, and that might actually come through this weekend. We'll have to wait and see. Still in March, Credit Suisse problems this is a large European bank that we do not invest in, but we have followed it, and they had a whole bunch of problems, big losses on hedge fund bets, spying scandals, money laundering. And on March 19th, a takeover announcement was made by Swiss bank rival UBS. So all of these failures of multiple U.S. regional banks, and then throw in the one European bank, all in the month of March, really drove a significant pullback in the finance sector.
Right. That is one heck of a storm cloud. I'm sure people are nervous and wondering, it gives you that tingly feeling. Is this going to be another 2008, 2009 financial crisis? What's your take? Why or why not?
Well, I guess there's a few things I can point out. First off is U.S. bank failures do occur regularly. And if you look at the FDIC, they have 563 bank failures between 2001 and 2023. So this is not a new thing. And they've become quite experts at dealing with these kinds of problems. But there's no doubt all that volatility and bank collapses really did stir up those concerns. And the evidence to this point really does show that this is not really the beginning of a 2008 financial crisis. There's a lot of key differences here. And so I guess one of the real key big differences is that in 2008, that financial crisis was driven by system-wide credit defaults, inappropriate AAA ratings, and mispricing of credit default swaps. So this was a very system-wide problem, whereas the problem we're seeing in March, this past March, was really more of a mismanagement of company-specific risks within a few small regional banks. Now, I'm going to exclude Credit Suisse because that's been a problem for a while, and it's sort of separate from this regional issue that the U.S. is having. So going through the big difference here, systematic large bank problem in 2008 versus concentrated few small regional banks this time round. And why is that? So there's a whole bunch of good reasons why. Number one is that the largest US banks have much more capital set aside compared to the regionals, and compared to the amount of capital they had prior to the Great Financial Crisis. So going into this problem, they were much better capitalized, the big banks.
Right.
Unfortunately, the smaller ones obviously weren't as well capitalized. And that is a key difference, is that in 2008, the banking system learned from the financial crisis and increased regulatory oversight for the large global systematically important banks. And those large global systematically important banks are the ones with the higher capital levels. And they are the key banks that the U.S. identified for the whole financial system. Bank of America is an example of one of them.
Right. So with that being said, we saw these reforms come through after 2008's financial crisis. Given, the highly publicized events this past March, do we think there might be some reforms for some of these regional type banks in the U.S.?
Absolutely. And this is something I do appreciate about the whole U.S. financial system. They learn from these problems, and
right.
They learned a lot from 2008, and they are learning now. And there's already talk about increasing some of these capital levels and liquidity coverage ratio requirements down to the smaller regional banks that are under 250 billion. All the attention has been to those systematically important banks, and that totally makes sense. But now they need to reach down a bit deeper.
Right. So, all of this, you alluded to all the volatility that happened in March. A lot of it comes from some of the noise in the markets. At IIC, I know we like to focus on fundamentals. So can you touch a little bit on how earnings have been doing for the banks that we do purchase during all of this volatility?
Yeah, for sure. So the banks we like to focus on are the big ones. And for the very reasons I just described, we know they are regulated more carefully and therefore safer investments for our clients. And so that's a very important thing. And it showed in the earnings in the first quarter. We had all this volatility amongst banks, but they were the small banks. Our large banks, or GSIP banks, global systematically important banks that we invest in, they had good results. They beat expectations, and showed their stability during times of crisis. And part of the reason is the higher capital levels, better liquidity ratios, more cash to deal with deposit withdrawals, many reasons. And so that showed up in the earnings for sure. And the trend, there was really two trends we noticed last reporting quarter, and those persisted through into this quarter, and they totally make sense. Is that one is that the slowing rate of net interest margin expansion is continuing. So we really had awesome NIM expansion throughout 2022, but that is starting to decrease, but still very, very nice margins and expanding as rates continue to stay elevated. And then the other trend is provisions for credit losses. We've seen those rising, and we would expect those to rise because they are normalizing. They have been extremely low for a long time. So this is somewhat expected as well. So both those trends are continuing as we noticed in the first quarter, and expect them to continue through this year.
Fantastic. Well, thanks, Steve, for sharing your insights with us today. As always, if anybody has any questions about what you've heard today or about your portfolio in general, please don't hesitate to reach out to your accountant, advisor, or financial planner.